All right. Good evening, guys. How are we? How are we? Slightly different setting this evening. Um, this week has been an exciting one. It's been a crazy one, and I'm actually doing this video because I may not be able to deliver a video on Friday. But there is something that's really important to talk about. So this is very much impromptu whilst I'm in a hotel in London. I'll get to a little bit of news a bit later on, but please do let me know whether you can hear me clearly. This should all work hopefully. So let me just open the chat very quickly right now. I know a few of you are already here. I'm good, Joshua. Thanks for asking, mate. Really, really good. How you doing? Read us news. Food Dweller, how you doing? And Mustang as well. Caught a live stream. Nice can hear and see you clearly, Pete. Perfect. All right. So there's a lot going on right now, obviously. There's news from the Bank of England indicating that we are effectively going to have a recession. This is the first time that the Bank of England have come out and actually said that openly last week. The forecast is we're going to have 10% inflation. Okay. Now, inflation is bad enough when you consider that it's the cost of things around us, right? The things that you'll buy in Tesco's that essentially make up your basket, essentially, right? So food is going to increase. To top that off, we've also got fuel prices, energy prices. Things are going to get really, really difficult. Now, with energy prices specifically, we've just had a huge increase already. There's going to be another one in October, about 40%. Now, off the back of that, most of you who watch this channel are investors. So naturally, if you're anything like me, you've probably been looking at your trading 212, your eToro, you've probably been getting notifications, ping, ping, ping. And if you read the notifications, market is down, this stock is down, everything's down. So I wanted to take this moment, and I did this earlier on Instagram. I thought it's only right that I do it here as well, because this is where the larger audience is. I think it's really, really important for me to give maybe my 2 cents around, if you are investing right now and you're panicking, look, you're in the boat with everybody else. But I do want to maybe just go back to some of the fundamentals. If you follow me for a period of time, be that even 6 months, 2 years, whatever, you know that I've always spoken about the fundamentals, the basics around investing. Those are three very, very simple things. Understanding what your goal is, understanding your risk, understanding how long you want to invest for. Those three things should dictate how you invested, whether it was right for you to go and pick an individual stock or to go into an index fund, or whether you should go with a robo-advisor, maybe someone like Wealthify, for example, or any other provider. Those three things would have dictated how you invested in the market. Now, I put my knowledge out there from 15 years in the industry because I'm passionate about investing and I wanted to have conversations with people that I wish someone had with me when I was in my 20s. The lessons that I've learned are, I say this now and I feel old for saying it, but from my time and from my experience specifically. Now, I completely understand that it feels as though we're in a new era right now, where because of the emergence of fintech, trading 212, eToro, accessing individual stocks is so easy, and it's the sexy thing to do. It's the thing that is most attractive to people, right? But in times like this is where, and I get so many DMs, and I've had so many conversations with people already, where there almost feels like there's a moment of realization that, oh my God, I didn't realize that the markets could turn this quickly, that my stock could be down this much within a relatively short period of time, especially if you've only just started to invest right now. And so I wanted to give a few words of encouragement here and maybe a little bit of perspective. So something that someone said to me a bit earlier today was that there are videos now that are telling you that you should lump sum into the markets right now instead of pound cost average or dollar cost averaging. And I think we really need to speak about this. And straight off the top, I just want to be 100% clear on a couple of things. First and foremost, what you do with your money is your decision. Whether you go lump sum, whether you DCA or PCA, whatever you do, it's your decision. You have to live with the decisions and the consequences of that decision, okay? So it doesn't benefit me whether you make the right or the wrong decision. I'm simply here to share my knowledge, my perspective from being someone who's worked in my industry for a very long time. Now, I think I've done a video about this anyway, previously on the channel, but let's talk about lump sum versus DCA or PCA. So that's dollar cost averaging, pound cost averaging. And let's talk about the fundamental reasons why you would pound cost average or dollar cost average into the markets versus lump summing into the markets. Now, I did do a video maybe 2 weeks ago. It was about how the markets react during a recession. So before, during, and after. The data is very, very interesting. If you haven't watched that video, maybe go watch it because it will give you an insight around what the historic data says. But basically, right. So if you are with a lump sum right now and you're questioning yourself around, well, should I pay that lump sum into the markets? There are a few things you should 100% know. If the Bank of England is right, if we do get to 10% plus inflation with the energy prices and the bottlenecks that we're still experiencing because of the back end of COVID, and the recession hits in 2023, you could see a sharp fall in value of the lump sum that you put in. Now, the argument for investing a lump sum into the market is that numbers will tell you that over the long term, a lump sum investment is going to perform better than if you paid money into the markets on a monthly basis. Now, if you have a lump sum, again, your goal, the level of risk, and the level of risk here is high because the Bank of England signposted a recession in 2023. So if anything, the propensity for a recession is the highest it's been for a while. This isn't now just speculation and rumor. The Bank of England came out last week to signpost to this because they are already seeing the economic markers for a recession. So that risk is high right now. And that is the second factor in everything that I've spoken about on this channel to kind of get people in the right frame of mind to make the best decision possible. So that risk level is really, really high. The third thing is your timeline. Now, if you've got a lump sum and you're clear on your goal, you're happy with the risk of, right, there could be a potential recession in 2023, I'm okay to ride it out, I'm investing for 15 years, then that could be the best thing for you. However, and I know many people who watch my channel are all about investing for deposits for houses, you probably shouldn't be putting a lump sum in knowing that there is likely going to be a recession in a short period of time. Now, let's talk about pound cost averaging, dollar cost averaging in. Typically, when you dollar cost average or pound cost average into the markets, it's typically because you don't have a lump sum available to you. So because you don't have a lump sum and you don't want to wait, you want to participate in the market, feeding money in on a monthly basis makes sense. Now, this is the beauty of pound cost averaging into the markets. It allows you to buy units at a discount price. So if a market price is, say, £1, right, for this stock, yeah, £1. For every pound you buy, you pay in, you're going to get one share, right? This is just an example. Now imagine that the value of that stock is falling from £1 to 70p to 60p to 50p to 10p, right? And you're paying in month by month. So first month you've got your stock for £1, full price. 3 months in, it's down to 70p, right? You're getting more shares for the pound that you're now paying in, right? You're getting 1 plus a bit. Now imagine 6 months down the line, that stock is now worth 10p. You're still putting £1 in. You're getting 10 shares for the one that you were getting months back. That's the benefit of pound cost averaging. And the whole idea is that when the market is falling, you continue to pay money in, you're buying this stock at a discount price. And the reason why that's important is when the market starts to rebound, the stocks that you bought for 10p a share will generate better returns as it soars back through. And you only need to see small incremental increases to get a really good return. So if, for example, you get 10 shares for 10p, if it goes up to 15p, you're in the money. 20p, you're in the money. 30p, you're in the money, so on and so forth. It allows you to smooth out your volatility. But again, pound cost averaging, dollar cost averaging was mainly for people who didn't have a lump sum to put in the first place. Now, I say that to say this. There are arguments for both. So when you're watching YouTube channel, please take it with a pinch of salt. This is the rule that matters that you absolutely need to know. You should always make the decision that is going to help you sleep best at night. Period. The numbers, the science, the research, the data does not matter. If you have a lump sum of money right now and you are happy to put it into the markets, speculate for 10, 15 years, you know your goal, you're happy with the risk, you're happy with your timeline, and you're going to sleep well at night, that's what you should do. However, if you're the kind of person that doesn't necessarily want to sit with the money in a lump sum account where you invested it knowing that there's going to be a recession, you're not happy with the risk, okay? You might be investing for the long term, but you're not happy with the risk, but you're clear on your goal. If you cannot tick off those three factors, maybe you should pound cost average in if you're happy to do that. The third option is this: do nothing. And this is something that maybe I don't speak about all the time, but this is a really important point. I've said it before on the channel. A loss is only a loss on paper until you crystallize it. So if you're already in, maybe don't sell all of your stocks. If you're happy to take that hit because it's just too hot in this kitchen, then by all means, you can get out. There's nothing wrong with doing that as long as you are happy with the fact that you're going to crystallize a loss. But the choice is yours. What helps you sleep better at night? That's all that fundamentally matters here, because you're going to get so much noise here on YouTube. And it's going to be hard to decipher, especially now, what you should do. So when you are watching my videos, whoever videos that you're watching, ask yourself this underlying and fundamental question. What decision is going to help you sleep best at night? If the answer is X over Y, you should do X and be happy with it. Don't second guess it, because at the end of the day, the decision is yours. If you watch my videos, you watch my live, you may make a decision based on what I've said here, or a decision based on what another YouTuber has said. Guess what? Neither I or the other YouTuber has to live with the consequences of that decision. So what makes you sleep best at night? That is the right decision for you. Don't worry about the research. Don't worry about the data. Don't worry about how people spin facts, figures, and so on and so forth. It's irrelevant. What makes you sleep better at night? I wanted to say this because I don't know if it's being said enough on YouTube, and there's still a lot of hype stuff going on at the moment. It frustrates me to a certain extent. And again, maybe I care too much because I am from the industry. I understand how this works, and I've seen clients be impacted when a market crash happens and you have to tell them, by the way, sorry, you can't take that income that you needed. It really hurts them, and it hurts to be able to deliver that kind of news to them as well. Thankfully, many of you who watch this video and follow this channel aren't at that point where you need it for retirement income, so you don't have to worry about having that conversation. But that doesn't mean that if you have an investment portfolio and you're seeing red, it doesn't make it any less painful. The biggest thing you're going to have to deal with is this: psychology. It's so hard. You're going to have to control that urge that you're going to feel to be like, I need to protect myself and get out. You kind of get better at it with experience, but many people who have only just been investing for the last 18 to 24 months have never been through a market crash, have never been through a recession. And, I'm getting messages from people saying, I didn't know that this could happen. Why? Because you've been sold the dream of 10x stocks, 15x stocks. This is the next thing that's going to make you rich. Unfortunately, the reality is that markets are cyclical. And now it feels like we're in that downturn. And so you need to really try and control this. And remember that fundamental question: what makes you sleep best at night? That's what I wanted to say in this video. I don't know if it's going to resonate. Hopefully it does in some way, shape, or form, whether you're watching this live, whether you're watching this as a replay. But please don't get caught up. The decision that you make, you've got to live with the consequences. A YouTuber doesn't, a podcaster doesn't, it's you. So please make the right decision for you. I do have a few bits of news. I want to say thank you, first and foremost, to everyone who's given me positive feedback on Secret Spenders episode 1. We've got episode 2 coming out tomorrow, 8 p.m. on Channel 4. So if you haven't watched the first episode, you can watch that on All For The Player. It's really cool. I think it's very timely given where we are right now with the cost of living crisis. I did all the financials and all the numbers. When you're seeing that people can save £20,000, those are real numbers based on recommendations of how they can cut back. And that's not draconian cuts where you've got to live on the breadline. No, it's still giving people the budget to be able to do things. And one thing that really stood out to me is that it's amazing how much we spend without really realizing how much we spend because we don't look at the numbers. So paying attention to detail is really, really important. And this didn't happen last Thursday, thanks to Andrew Bailey and the Bank of England increasing interest rates last week. But I was supposed to be on Lorraine last Thursday between 9 and 9:30. That got cancelled as I was on the train arriving into Euston. I'm in a hotel right now in London because I'll be doing Lorraine tomorrow morning at 9:20. So if you do watch daytime TV, you'll be able to catch me on Lorraine tomorrow morning on ITV. If you do watch it, please do let me know. Let me know how I did. But yeah, it's a very, very exciting time right now. I'm a bit of a whirlwind right now because obviously the show's going on. We've still got 3 episodes, 2 episodes after the one that airs tomorrow evening. And there's a lot of other stuff that I'm pursuing as well around programs and things like that. I will give an update on the channel, but like I said, this video right here is probably going to be my Friday video because things are just crazy. I've got meetings in London on Friday. I've been shooting for 2 days in Cardiff. And doing a video has just been very, very difficult. So I hope that you found this useful. I'm just going to scroll through the chat, see if there are any questions that I can kind of answer before I head off. I don't want to ignore those because I appreciate that there's about 80 of you on here right now, and I do appreciate you spending this time with me on a Wednesday evening. Tim here is just saying, let me just say good evening actually to the people on here. So Tim's on here, Michael's on here, Matt, Food Dweller. Okay, I'm going to come back to this one from Food Dweller, but let me just answer this quickly from Tim. I did sell my Palantir shares, then bought the VUSA with the money. That's not bad. I mean, if you're happy with the position that you bought and the VUSA, I mean, I've got the VUSA, but I'm down it at the moment. That's just swings and roundabouts. You can't get it right 100% of the time. Swings and roundabouts. You've got to be able to roll with those punches. Where are we? There was a question from, I think it was Andy. Food Dweller. Do you think stocks will go down more? I think yes. If we enter into territory where inflation doesn't come under control as expected, I think stocks have room to go down even further. A lot of the economic data, I think we've got economic data out tomorrow here in the UK. So whether GDP is positive or not is going to be a big indicator. Over in the States, I mean, their inflation number is a little higher than ours. They're battling the same thing. Their employment numbers, their economic data is going to be really, really important. If they're not good, you can almost guarantee that the stocks are going to go down because it's all about confidence. The market runs on confidence. So yeah, I think that there is still room for that to happen, 100%. Let's see, what else we got? Ian's just saying there, very sound advice as always. Thank you, mate. I appreciate it. I know that I feel like sometimes I just repeat myself and it's boring me saying the sensible stuff, but I think the sensible stuff needs to be said sometimes. And yeah. Do you sell one share at a loss and then use the money to average down on another? No. I mean, I definitely wouldn't do that. I mean, look, if you bought a share and you sell it for a loss, you're then going to go and buy that at a lower price. You've crystallized. It doesn't make any sense to me to do that, really, to be honest. Particularly if you haven't got it in things like ISAs, and depending on the size of your portfolio. If you haven't got a large one, you don't have to worry about capital gains and all that kind of stuff. But for me, that doesn't make sound investment practice, right? If it's down at a loss, just hold it because you're crystallizing a loss to buy at a lower price. And fair enough, you might get a bounce going forward, but it just doesn't make any sense to me. So I don't do that. I wouldn't do it. But again, if you think that it makes sense for you, then by all means you can do that. But it just doesn't make any sense to me. I heard that when you buy stock, you should write a note on all of the reasons why you bought the stock. When the stock falls, revisit your notes and see if any of the fundamentals have changed. 100%, yes, you should. So the whole point of that, and on this channel, I talk about buying individual stocks, and I talk about investing in index funds and using providers, maybe again like Wealthify or something similar. It all depends on, number one, your level of knowledge, whether you understand what to look for when you're researching the stock. It's all about whether you have the time to manage the investment, right? So if you're hearing news, economic data, do you know how to decipher that economic data to make a decision about the portfolio that you hold? That will inform when you take profits, if you should take profits, whether you should rebalance, reallocate the portfolio of stocks that you hold. All these factors are really important. You need to understand what you're doing with that. So for me, when I buy individual stocks, I am noting down, right, what are the key metrics that I'm looking for? Number one, what do you want from a business? Do you want dividend? Do you want growth? Do you want a combination of the two and total return? You write that down. Okay, how does that company actually perform against those benchmarks? How many boxes can you tick? Then if you're looking at all the financials, are they making profit? Are they paying dividends? What's their runway, their cash runway? What is the business forecasting? Are their revenues increasing? Are their revenues falling? Is their operating profit increasing? That kind of stuff. What's on their balance sheet? What's on their cash flow? You're looking at all of that and you're ticking boxes. And the idea is that you will have a sheet of boxes that you're meeting your requirements with. So as anything changes with that stock, those things might change, but fundamentally, in the back of your mind, when you're buying, you should always have, right, if this happens or this box becomes unticked and it's very important to me, I will sell or maybe cash in this investment or maybe take profits and have maybe even, landmarks or stages where you are taking profits. All those things are important. If you bought individual stocks off a video on YouTube without doing any of that stuff, you've probably not really done adequate research. I mean, I was reading a post the other day where someone was talking about the upside for this stock on the research is 350%. Like, based on what exactly? Especially if it's a new stock, how can you quantify that? So a lot of this stuff is pie in the sky, and you have to be comfortable with the decision that you make and comfortable with the research that you do on a stock when you buy it. It is so important. Again, I'm going to say this. It doesn't matter whether you're watching me or anyone else on YouTube. I don't have to deal with the consequences of the decision that you make. If you make a mistake based on a video that you viewed and it costs you money, guess what? You're holding the bag, not the person that you watch, not the person that may have said something that wasn't quite right or isn't quite relevant because things change so quickly. So it is true, you should have those things because that should be your benchmark of when things are right and when things are wrong, and it informs what you're able to do and what you should be doing with the stocks that you hold. Duncan's saying he will DCA, he would dollar cost average into those stocks right there. Good. Thank you very, very much. What's this one? Going to stick to my 10-point rules plan regardless of circumstances. Listen, if you've researched it and you're happy with it, stick to the plan. That's what it's all about. Long-term investing, right? It's like a 100-mile journey. If this is happening in mile 3, what, do you just pack up, turn around and go home? No. You crack on because you've got another 97 miles ahead. It's exactly the same thing. If you're in your 20s and you're investing to create wealth for the future, this is a blip in the road. You've got another 20 odd years in front of you to really get the benefit from the market. So again, it's understanding what you're doing and be comfortable with what you're doing. Again, those 3 fundamental pillars: your goal, the risk, the timeline. Those things are so important. If you know what those are, it will inform everything you've done, and you can have confidence in what you've done as well. Thank you very much. This is good. Great episode last week. Looking forward to tomorrow's show. Mate, listen, there's so much that we could talk about on the show. It's a shame I can't get the couples on, actually. I might be able to get one of them on, maybe 2 of them, maybe 3, to talk about the show and their experience. But it's very much a Channel 4 thing, so I don't want to tread on toes, if you will. But yeah, thank you, mate. Really appreciate it. Tomorrow's one is fun. Tomorrow's one is actually very, very good. I've already seen it. I've seen a cut of it, and I'm still doing, the odd voiceover for some of the episodes. But yeah, tune in tomorrow. It's going to be really, really cool. I appreciate this, Kevin. You're a star and your rises prizes. Thank you very much for watching, Vic. I bought a lot of SQQ average. $20 is doing so well. It's risky play, but I'm happy. I'll DCA into other plays later. I love your channel. Found you a year ago. Thank you. Cheers, Vic. Appreciate it. Son of us as ever. Are there any other questions in here? Bad day for crypto again. Listen, I'm not looking at my crypto holdings because it's just depressing. I'm not looking at any of the investments right now. The worst thing you could do is look at your investments right now when the markets are down. I'm not doing it because I know how it makes me feel. And I'd rather just not look at it and just think, okay, I'm holding, I've got the money invested for a while. This is a blip. I don't need to pay attention to the red. It's my mantra almost. So yeah. Thank you for your calm and rationale in current climate. Taking a pause and watching the market will continue with monthly investments with long-term objectives. Thank you, AJ. Appreciate it. I don't have a TV license. Cannot watch. Can you watch your show? Thanks for all you do on YouTube, Mags. Thanks, mate. Appreciate it. Harry. Thanks for your insight in the video. Not directly related, perhaps, but do you have any recommendations for good places to start researching REITs and REIT ETFs? Do they have REITs in Smithy Wall Street? I'm not sure if they do or not, but maybe try them because they do have some really good data in there. Yeah, maybe try those. I don't know whether they have them or not. I don't think I've spotted them in Symphony Wall Street. Love your channel. I do my own research, focus on dividend stocks with AT&T. Got a nice bonus from the split now. Waiting for Amazon split and Alphabet. Would like to know the splits that you know. The thing is, I don't know what splits they're talking about. So we've got the Google split, the Amazon split, and there's going to be a Tesla split. We don't know what the ratios are going to be just yet. But I've got all three. Actually, do I have Amazon? I don't have Amazon, but I've got Google and I've got Tesla. So it'll be interesting to see what the splits are going to be later on in the year. That may give us a little bit of buoyancy. We might see a little bit of an uptick in the share prices prior to that happening. I like this. Never invest based on vibes. Never invest based on vibes. Unfortunately, a lot of that's happened over the last 18 to 20 months as you know the topic of investing has become so attractive. Detailing into a worldwide ETF pie. Good. Bad times coming soon, but optimistic for long-term outcomes. Can't wait to see you on Lorraine. Thank you. I appreciate that. To be honest, am I nervous? I'm not really nervous. I don't really get that nervous, but it's going to be a big moment, to be fair. It's like it's daytime TV. I used to work in that building many, many years ago. I've watched Lorraine for years and years and years. So it's very, very weird that I'm going to be sat opposite a couch on her show. I'm going to be sat opposite her on her couch on her show for 6.5 minutes talking about me and talking about the show. It's bizarre to say that. It's so surreal. And I don't think it's really sunk in yet. It will probably sink in when I'm there, sat down, and the cameras are rolling. But it just goes to show, like, man, you've got to venture. You've got to believe. You've got to, put your best foot forward and put your head down and try and do the right thing. And it's so, so difficult. I haven't done a live for a while. And I know that I've had a couple of questions asking me about why I've not done lives on a Sunday evening. Truth be told, I was in hospital maybe 2 weeks ago. I had chest pains. So live Q&As on a Sunday evening where I'm giving up, an hour and a half, 2 hours of my time, it's a lot. And, that's time that I could be having with my partner. And she gets a little pissed off with me sometimes. And when you have chest pains for a bit and you start thinking, well, how am I utilizing my time? Then I start thinking about YouTube and the fact that, this is great, but my bread and butter, if it is going to be YouTube, if I'm spending 2 hours on a live Q&A on a Sunday, I look back at the revenue that video generates and it's £6.30. And I kid you not, £6.30 for 2 hours, I start to question how I'm utilizing my time. And so I need to make a decision on the live Q&As. I think I'm going to maybe limit them a little bit. I really don't know just yet. There's a lot of stuff going on. I need to use my time a little bit better. I need to be looking after myself a little bit better, and maybe hold back. Maybe not on the content. Maybe that's the wrong way of saying it, but find a better balance. Because if I look at it from a crude point of view, I still have bills to pay, and £6.30 for a 2-hour shift doesn't really sort of make sense. It just doesn't. But I'm just being very open and transparent there for you guys to see. But yeah, we'll see. There is one here from Ian. Pete, is it more expensive to put money into a trading 2-1 pie, or do I invest individually in those stocks? I love the simplicity of a trading 212 pie. I mean, trading 212 pie is just a collection. So all you basically do is you've got those individual stocks, you put them into the pie, then you allocate or designate how much of your contribution you want to go into those individual stocks. So, for example, if you're investing £100 a month, you've got 10 stocks, and you split it 10% each. You're going to have £10 go into each individual stock. As far as I'm aware, the last time I checked, Pi doesn't cost you any additional money unless they changed it. So it shouldn't make any difference at all. But I have to admit, I've not really been too up to date with the T's and C's within Trading 212 myself. So if they're charging extra money for the Pi, then you could just, how can they charge you extra money? I'm not sure that they can't. Surely they can't, right? I don't know. But it shouldn't make any difference at all, mate, if I'm honest, because it's just a function that allows you to allocate where your money goes, in what proportion it goes in there. So, yeah, but it shouldn't make any difference at all whether you're buying individual or putting it into a pie. I think if you put it into a pie, one thing they do really nicely in there, you can forecast what it's going to be worth in 20, 25 years' time if you keep it on a regular basis. I think that's quite a nice function. So, yeah. Anyway, appreciate you guys. Thank you so much for joining. I really do appreciate you. If you do watch me again tomorrow morning, just let me know. Maybe take a screenshot and tag me, and let me know how I did. All right. Thank you so much, guys. Have a good evening, and I may speak to you on Friday. If not, might be next week. Catch you in a bit.